Good morning. So I will try to briefly introduce what MiFID is about, and especially with regard to the market structure aspects, which are the topic of this panel. As you know, on the 20th of October, the Commission has adopted a comprehensive package to improve the efficiency, resiliency, transparency of the financial markets, and also to reinforce investor protection. This is what we call MiFID II, a directive and a regulation, and together with the review of the market abuse directive as well. The idea is that the whole package, including all the implementing measures, will come into force at the same time, because there are so many interconnections between these two legislative packages, MiFID and MAT on the other end. In terms of timing, what does it really mean? I would say that the negotiations with the Council and the Parliament, they have just started. It will take at least a year, so it will bring us at the end of 2012. And we will need another 2 years, I would say, to develop all the implementing measures, etc., carry out proper public consultation. This means that the entry into force would be around end of 2014. This is estimates. The MiFID review is a broad review. There are a lot of there are several objectives with this review, but I just would like to focus on the first one, as this is the topic of this panel, which is essentially to update our regulatory framework to take into account the developments in the field of market structure and technological developments. First, we have introduced what we call the organized trading facility category. With this new trading venue category, we want to capture OTC trading, which is functionally similar to trading on regulated markets and multilateral trading facilities. So we want the same business to be subject to the same rules. This means that the transparency requirements for these three categories of trading venues will be exactly the same. This is why we have defined this transparency rule by type of financial instrument. And they will also be subject to core organizational and market surveillance requirements. The main distinctive feature between regulated markets, MTFs on one end, and the OTF on the other end, is that the OTF can exercise discretion in how orders are executed. But all the three venues we will have to ensure the neutrality of all three venues, and this is done in a different way because of that distinction between regulated markets and MTFs and OTF on the other end, is that for regulated markets and MTFs, the matching of orders has to be done according to non-discretionary rules, while for the OTF, we prohibit the operator of the OTF to trade on its own account, on the platform itself. Lastly, as the operator of the OTF can exercise discretion, it is subject to strict conduct of business rules as well. A quick word of the trading of derivatives is that this review will also be the way for the Commission to enact the G20 commitments. So we will mandate trading of clearing eligible as determined under our regulation on OTC derivatives, what we call EMIR, and derivatives which are sufficiently liquid to be traded on one of the three categories of trading venues, i.e. regulated market, MTF, and OTF. Again, under market structure, so we want to have effective competition. And so we want also to remove commercial barriers in the trading and post-trading space. This will essentially complement similar provisions which are under EMIR for OTC derivatives. As you know, EMIR covers only OTC derivatives, while MiFID is broader in scope. It covers all types of financial instruments. Essentially, we will ensure that trading venues can get access to clearing services of CCPs on a non-discriminatory basis, and the other way around, we will make sure that central counterparties can offer clearing services in whatever instruments is traded on a trading venue. And then we also want to enhance competition in the field of exchange-traded derivatives, and that's why we will make sure that the access to data feeds and the licenses is made at the disposal of CCPs and trading venues on a reasonable commercial basis, so that the derivatives built on these indices can be open to competition. A quick word on SMEs, if I still have the time, is that it will not solve all the SME problems, but it's part of a broader package. We want to facilitate the access of SMEs to capital markets, and we will do this under MiFID by creating a voluntary quality label for SME grow markets. In fact, we are building up on the existing SME junior markets, which are registered as MTFs, and we want to harmonize at the EU level the transparency requirements and listing requirements for these venues by harmonizing upwards these transparency requirements. We will ensure a certain quality, try to also foster the trading of these SME shares across a network, so that these SME shares can be traded also on other SME junior markets. And at the same time, we will also try to keep at a high level investor protection, so to strike the right balance between transparency and investor protection. Finally, about algorithmic trading, I would say that the main objective is to provide for proper safeguards around these technologies while while preserving their benefits. And it's a multi-pronged approach. First, we want that all algorithmic traders are authorized and regulated under MiFID. And we also want to reinforce organizational requirements along the trading value chain, so both for trading venues and investment firms. That's the risk management part of this approach. Then these measures will be complemented by the review of the Market Abuse Directive. In our market abuse regulation, we propose to clarify which high-frequency trading strategies are clearly prohibited market manipulation. And at the same time, we want to provide the necessary information to regulators and the necessary tools for them to detect and sanction these manipulative practices. That's why we have record keeping for orders, flagging of orders, etc. And finally, we also have a controversial provision, probably everyone has heard about it, is that algorithmic traders shall keep their trading strategy in continuous operation and provide liquidity on a regular basis to prevent them withdrawing abruptly from the markets. Yes, so that's it for the market structure part.